Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Hello and Happy New Year from Revere. This is a continuation of our New Year's show last week. If you didn't get it, you better go check it out. And do you have a guesser for your advisor? Do you have a guesser or do you have a real advisor managing your money? Is he forecasting, aka guesstimating, for some year out arbitrary date and then rebalance on some arbitrary date, target date, asset allocation, lifestyle, 60-40, all the same stuff. Don always says it's diversification. Do you buy rotten vegetables and fruit to have a balanced diet? Why are you doing it in your portfolio? Or now, so is it a guess or is he just spreading it out because he doesn't know, or she, and so she's giving you a pie chart portfolio? Or is it worse? Is it nefarious? Is he or she a guesser, or is it more sinister and they're actually an assassin of your money? And they may not even know it. They may be middle management and they may be drinking the Kool-Aid, the Wall Street Kool-Aid. See, you're the cattle, he's the roper, you're the product, he's delivering you to that state, municipality, emerging market company that is their client, that they have to fund. You see, they need to fund their clients' borrowing needs. And they've got clients, they've got big companies raising hundreds of millions of dollars of bonds, stocks, IPOs, emerging markets, countries want to raise money, municipalities. That's their client. Investment banks, aka custodians, like even Schwab and Fidelity. You know that Goldman Sachs and Merrill Lynch are big investment banks doing that, but so are the discount brokers. The whole point is their big clients are really the companies and the countries. They're raising money for them. They need to spread it out. When everybody's going to the S&P, nobody wants emerging markets. We've been telling you for 5 or 10 years, do not have any emerging markets, because if they're not outperforming America, why would you own it? Because you got two risks. You got the currency risk and the return risk. So you got much more risk overseas. If America's much stronger, why would you have it? Why would you have a pie chart of emerging markets or even Europe? They've been doing horrible. America's a place to be, and even large cap versus small cap. But they want you to have a big pie chart of a lot of stuff so that they can fund their clients' needs. So is it about your money or is it about the brokerage firm's money? See, silly rabbit, you thought you were the client, but you're not. They're taking you and they're taking you and they're giving you a pie charts or us, and they're spreading it across all those other places that they need it for their real clients. So either way, it's one of the, and by the way, a lot of these brokers don't even realize it. They believe this asset allocation, pie charts or us portfolio, that it's going to protect you. Folks, you want enough diversification on the way up so that one stock doesn't kill you if they're lying about it, like Enron did years ago, right? But on the way down, all the correlations go together. It all goes down together. You don't want diversification. You want out. You want cash. You want defense, or maybe treasury bonds, or maybe gold. But you don't want diversification on the way down. You only want enough, just enough, on the way up. So I ask you, if you still have a pie charts portfolio with a bunch of this and a little of that spread out everywhere, you're going to make 7% annualized. That's what's going to happen. That's good enough. That's fine. But there is a better way. We'd love to show you. We put out free stuff every day the market's open. Just go to revereasset.com, sign up for our daily newsletter. We put this stuff out all the time. And so I'm going to touch on this. So we've got a mailbag. I got a few articles in there. I'm not going to kill them or go over them. One is the big portfolio management problem nobody's talking about. It dovetails perfectly with the topic du jour. It's almost like I picked it. Then they got California muni bonds, and you know how these California municipalities are going to be they're going to have to try to raise money. I talked about that right after the fires. Glad they're catching up. And then the stock market, my favorite article, stocks are due for a correction. It says, nobody's really expecting a correction. Wrong, we are. We always expect it. We could think the market. But anyway, it says President Trump's pro-growth agenda is the market's going to fluctuate. Doesn't help you manage money. Doesn't tell you how to get defensive. The portfolio management one, it's talking about the concentration of assets in large cap stocks. That's why you need a sell discipline, because when the large cap goes, this whole market's going, and it's going to be ugly. But for right now, the market wants to rally. It's going higher. It's moving higher. It's making all-time highs, and it doesn't care if you're scared. I'm scared to death. That's why I got sell rules, because I'm fully invested, but I'm scared. But at least I have a parachute. Anyway, I'm going to go straight to the mailbag very quickly, and then I'm going to go and the articles from the mailbag if you want to reach, and then I'm going to go to the team and we can talk about it. All right. This is on 121. By the way, if you got any questions or comments you want us to review on air live here in real time on Friday, just send me an email and we'll talk about it, or a topic. All right. 121 FC. This is a client, full disclosure. Dan, I'm considering a $100K gift to each of my 2 kids to assist their first purchase of a home or upgrade an existing house. And rather than wait until I'm dead, that means pulling $200K from my Roth. I can't take it with me. I figure I'll put it to good use. I'll let the rest build for my old age needs if I ever have any. Here are the good questions, good for planning. Is my wife able to participate in the gifting scheme allowed by the IRS $19,000 in 2025 since IRA money is mine alone? This Roth IRA. Is my wife allowed to participate? This would add $76,000, $19,000 per person times 4. If we gift to my daughter and her husband, correct? Number 3, regardless of what I give under the gift tax exclusion, the $19,000 a year, I can make up the rest of the $100K filing the IRS Form 709 using my lifetime exemption, correct? Question mark. The lifetime exemption being multi-millions, although Congress is constantly fiddling with it. When giving these gifts, IRS will have an eagle eye. What is the best method for making the transfer? Me. You have a very good handle on it, and so yes, use your annual gifting to the most extent possible, meaning using the 19 first, and then tap your lifetime exclusion. Yes, each gift you can give up to $19,000 to anyone, even me, if you like it. You can make your money my money without any tax implications. Above that, you'd use your portion of lifetime exclusion, approximately up to $13 million for each person, if done correctly. If done incorrectly, both husband and wife only get $13 million once, not twice, but will sunset down to approximately $6 million on January 1st, 2026, if done correctly. So if you done correctly, you can protect $12 million. If you'd have it incorrectly, you can only protect $6 million as a couple. Therefore, high net worth people need to plan quickly or pray Trump extends his tax cuts. If it's your Roth, so you would have to make tax-free distributions to your joint account first, and from there you can make the gifting. You cannot gift directly from the Roth because it's considered a distribution anyway. In other words, it can't stay in Roth form. So yes, you make the distribution in your joint account that both you and the wife distribute the money from there. Okay. Now, number 3, great move. You've been listening and have applied the principles of your money well. Number 4, directly into your bank account. He's asking how to do it transactionally, to keep track of it. Directly into your bank account from there is keep the transactions and confirmations, and then simply file the appropriate gift estate form. He said that's 709. This essentially puts IRS on notice. It's the cleanest way to do it. It is unnecessarily to file form if you're simply doing the $19,000 per year, but anything above that you should file. Now, people actively ongoing filing every year because they've got estate problems, they will file even if they're just doing the 19 a year. They just want to keep track of it and let the IRS know. Anyway, that was the second mailbag. Here is the first mailbag, and I had to read this because he's a wonderful guy and I like him very much. 121, it also Now it's us. CS. Oh, another CS. Thank you, each of you. You have blessed my family and my friends who came with me. And please thank your spouses who support you so you can stay focused. Thank you for your discipline. Thank you for your honesty and transparency. Your efforts have really blessed a lot of people. We are grateful. Our futures look bright, and this is a new golden age. And a big thank you, an incredible 2024 return. Me, thank you for the kind words. It is why we do what we do. So your money will look just like our money, Don and Mai's money. Cheers and Happy New Year. That's actually from a client who was actually an active investor and helped a group of people, but was kind of wanting to settle down and kind of go off in the sunset. He didn't want the responsibility, and he came on board as a client, and then he actually made sure what we said we were going to do. And then he started referring those people he was helping, and now they're all happy. Folks, not only when you become a Revere client, we onboard you, we put out a video every single night the market is open, about a 10-minute video telling you the short-term, mid-term, long-term strengths of the markets, and then what we're actually doing, some of the things we're doing in the portfolio. We're the most transparent advisor that I'm aware of in the world, not just the country. We tell you every day what we're doing, and then we do this podcast every Friday showing you what we're doing. Okay? And we're doing very well. And there are no conflicts of interest, and I eat my own cooking, and so does Don, because our portfolios looks just like yours. And with that, I am going to turn it over to Don, and Don's going to talk about your money, if you're a Revere client, and what your money looks like, because it looks just like my money. So Don, pray tell.
Yeah, Dan. Let's start off with what you said at the open. It's if you're with a pie chart advisor, they may just not know any better, and that's absolutely true. It's not anything nefarious that you're underperforming. It's just that they're not technicians. So there's two categories that it can fall into. Is it unconscious incompetence, which that's the truth in this case. They don't know a better way. They've been trained by Wall Street to just stick people in a pie chart. But if you start presenting some ideas to them about protecting the downside and they say, no, never mind, that doesn't work, forget about it, then it goes to willful ignorance because they're not interested in learning about a better way to do things or a way to protect the downside. So there's two categories that can fall into. The worst is the willful ignorance. Those are the people that you try to explain to that all bear markets happen under the 200-day moving average, learn how to read a chart, and they just dismiss you because some academic research from 50 years ago said that I need to have a pie chart.
That's been being disproven, by the way, as we speak. Go ahead.
100%. I mean, if they did the same study now and saw the underperformance of international and emerging markets versus the U.S., and this is really a geopolitical situation. The U.S., with the lack of overbearing regulations, has permitted the climate for people to innovate and to create the internet, artificial intelligence, and all of the breakthroughs that we see from a compute standpoint. But
right.
Europe likes to brag that they're the most. They always lead the way in regulations, but what they're doing is they're putting a boot on the throat of the people that are trying to innovate, and they all end up coming to the U.S. because this is the place to be for, and now especially Stan Druckenmiller, legendary investor on CNBC on Monday, talked about the animal spirits in the market. Right. He talks to a bunch of CEOs, and they're really anticipating a favorable climate for their businesses to succeed. And the first and second quarter earnings, first quarter or Q4 is happening now in first quarter of 2025 as the earnings come out. And the market had a great January after sliding during December for whatever reason. But again, we can't predict when we're going to go higher, when we're going to go lower. We just know that we've got a plan every day. We come in competently ready for all situations. We've got 4 technicians on board, plus
two
Alex,
consultants. Yeah, 2 consultants. Yeah.
We're nailing this thing down to the minute details of the various stocks and sectors and market. And that's why when clients come on board and they say, well, let me just start out with 25% of my assets. How many times have we seen over the past year people say, yeah, you were right, let's just bring the rest of it over.
It happens in
And
2
people
months.
say, well, I'm with Merrill Lynch.
Once they see that you're doing exactly what you say you're doing, like you say, I'm buying 3.4% of this stock, and it's exactly 3.4% in their portfolio the next day. They become, and then they feel in real time what you're actually saying on the video, Don. So before they tell me that it's kind of hypothetical in the internet ether, kind of out there in cyberspace, but they become a client, and now they're feeling in real time what you're actually saying on the video.
And then we explain it every night too.
Yeah.
What's going on with the market? What are the inter-asset correlations that are impacting what's going on? We've been highlighting how the dollar has been weakening over the last 2 weeks, and that's been good for precious metals. And we own GLD and Nugget as diversification when it's a favorable climate. That's
right.
We're just going to and Bitcoin as well. We're not going to diversify into asset classes that are going into a downtrend. Those are the rotten vegetables that I speak about.
And I should make such blanket statements. So when I say emerging markets are bad, almost in general, if you're going to buy an emerging market mutual fund that just blanketly buys every emerging market country, you're going to get 98 rotten vegetables and 2 good vegetables, India and Argentina, right? Well, you could just buy those 2 country ETFs if those were better than your top 8 choices of good American companies. In other words, all these investments stand on their own with their own relative strength. So just like the emerging markets, you got to pick and choose. You got to pick and choose U.S. stocks and where to be large cap, small cap, mid cap, or large stocks. So Don's going to show you how the team does that.
Ted's showing a comparison chart there. I'm just narrating today. He's doing the chart driving, but you can see the massive outperformance by the S&P 500 and emerging markets. And short term, medium term, long term. We use 3 time frames and put our capital in the market accordingly, not according to what we think, but according to what the market's actually doing.
So hang on.
So Ted,
on that chart right there, I want to point that out. On that chart right there, folks, what they're saying is diversification is safer for you. And what I'm saying, that's nonsense, because that emerging market is taking you down. It's the rotten fruit that's reducing your performance. And I think negative 5% is much riskier than a positive 5. If I'm trending upward, I think that's less risky. If I'm trending downward and I'm losing money, I'm getting riskier and riskier the more money I'm losing. So why is it, think about this, does it make sense to hold downtrending assets, and that's supposed to be diversification to make you safer? Just think about it. Logically, it's stupid. Don?
Yes. You're right. 100%.
Sorry, you just get me going. I can't help it. I can't.
No any other way to put it. Ted, bring up, add SCHD to there. This is a Schwab dividend portfolio. Everybody says, I love my dividend. Look at the underperformance versus the S&P 500 when you're in the quote unquote safest dividend stocks. And throughout December, for no reason that was apparent to me, we just value stocks fell massively out of favor, and all the money flowed into the big NASDAQ 100 type names. You can see the outperformance there, with it being at the top of the chart. Put VXUS in there, Ted. That's Developed International ETF. And you can see how far that basically looks just like emerging markets. It's the rotten vegetables, the rotten fruit, and we're going to focus where the capital's flowing to, not because of some stupid academic research done by a PhD that wrote a paper 40 years ago. We have no time for that.
Yep.
All right, so let's go back to a daily chart of the S&P 500, and very simply, we've had a massive change in the outlook, and it wasn't our opinion. On January 13th, we put in a bottom. We broke the 21-day. In the weeks leading up to that, we broke the 50-day, and we came down. It's not showing on the chart, but that's around the 20-week, 100-day. And every pullback over the last year, since the bull market, really a year and a half, so the bull market started in November of 2023. Every pullback has been to the 20-week / 100-day moving average. We messed around at that level. We bounced at that level, and we had a gap up, and we did an undercut and reclaim on the 13th. That put in the bottom. We reclaimed the 100-day, and we started working higher. The first lower term moving average is the 8 EMA. We reclaimed that. We reclaimed the 21. We reclaimed the 50, and money's flowing back into equities. During the most important thing, we're going to skate to where the puck is going. The puck was being dominated by leading stocks throughout December. They held up extremely well. We pointed this out in every video, every night, showing the leaders. So we got stopped more on our index longs than we did on our leading stocks. We didn't just throw the baby out with the bathwater. They were working. There's no reason to sell them. We have our stop set. We adjust them every day. We raise them. We have a calculation that we call rebar, Revere estimated balance at risk. If all of our stops were hit, we know exactly what our downside would be. And we turned along with the market. It's like bending like a tree in the breeze. If the wind is in your face, we settle. If the wind is going sideways, if we're coming off of a high, we'll back off. If we're coming off of a low, we'll start getting re-involved. And then when it switches to a full-fledged tailwind, which is where it is now, we get our exposure on to as most comfortable as we can be. TurboTax, a little bit more aggressive, has some higher beta stocks in it right now. Right. NBIS, really kicking butt for that portfolio. We don't have that in Grotection, but we have it in TurboTax. And it's look at that fantastic breakout after a pullback.
So folks, what Don's saying is he's actually managing risk using relative strength. So we're going to focus toward the 30 or 40% strongest areas in the market, and we're just not going to participate in the workers 30%. See, in the pie charts are us, they just scattershoot and buy you everything. You just want to focus on the strong. And by the way, then take it a step further. So Don's saying we want to traffic in the growth stocks primarily because they pay you more when they're working. When they're not working, they're nuclear waste. You want to get out of the way. Sometimes there's a rotation into value. That's using relative strength. Now, if none of it's working, then we can go to cash. So we always want to look for the strongest sectors and focus there. And if nothing's strong, you've always got the emergency ripcord. So
yeah, we hadn't owned an oil stock for a year, and EQT, a handful of oil started working well, while the oil ETFs looked terrible. And again, that's isolating relative strength, broke the downtrend line, broke out of the nice double bottom base, and it's been acting extremely well. In fact, got so extended that we did some offensive selling this week on that, as it touched the +4 ATR twice over the past week. And normally that means, something's going to pull back, and we've got a list of other oil stocks that are holding up well on our list that we may pivot into, or we may re-add this if it pulls back to the 8 EMA and gives us a shorter term low risk entry signal.
Well, Don, the only good thing about the pie charts or us portfolios, they're alive and well, is they're feeding Revere, because these people, after every bear market, they end up losing 30, 35%, and they get tired of it, and then they find a better way.
And then the point there is the time to bring your asset. The bull market will make a genius out of every advisor. But a pie chart advisor, returned 8, 9, 10% last year. We blew that out of the water, as we have over the last 5 years. But the time to bring your money to Revere is when your account is at an all-time high. It's not after you've had the 20% drawdown because your willfully ignorant or unconsciously incompetent advisor was unable to get you out of the way. That's the time. The time to bring it to Revere is now, when we're near the highs. Because the next bear.
Yeah, I always say any time's a good time to come to Revere, but the best time to come to Revere is before the next bear.
Yeah, I mean,
right?
we had a recent client had half our money with us, half the money with the pie chart guy. He's approaching retirement. He said, "What can you do to protect my downside?" The guy said, "Well, we just think long term. We just don't sell things if the market gets weak because we're not market timers." Ends up that all that money is with Revere now.
Yep.
And it's not because we sell a story. It's because we back up what we do every night on video. Those videos are invaluable to people that manage their own money as well as to the clients to find out what's going on. And some people look at their balance 4 times a year
Yep.
on the quarter, and that's fine too. But they're sleeping well at night because they know that it's a smooth equity curve. It's like driving on a map from Arizona up to Maine. You don't want to have detours down to Louisiana with those big drawdowns. You want to keep going smoothly from lower left to upper right, and that's what we're all about at Revere. And this is personal to me because my father-in-law got screwed by one of these big brokers when he was dying of cancer when the internet bubble burst, and watched his big retirement nest egg get cut in half by Morgan Stanley.
That's what you realized they knew less than you did. You lost a lot of
Yep,
money, and you saw his statement when he died. You went, "Oh my God, they lost more than I did. They lost half their money."
Yep. Knew there had to be a better way, and found the William O'Neill method and applied it to be able to scale to managing. We crossed $230 million last night in AUM. So
growing right. Yep.
It's we're proud of what we do here, and we will blow our own horn because there's no better. Honestly, I really don't. If there was a better way, we'd still be looking for it. Let's put it that way.
Oh, well, we always are. We're always upgrading. We've actually got an independent data scientist. That's his actual college degree. He's a data scientist who actually test our data. Like when Don buys in, is it a half position size first and then 30 and then 20, or should he go 20, 30, different? And he can do all those different iterations and see if there was a better way to leg into a buy, or when you sell offensive sell, do you sell the whole thing, or is it better to take half? He can do all these different things. In fact, he helped us adjust our unique stop losses for each stock. So we're constantly improving and updating our rules and research, and we share that with you. We've got a ton of stock nerds that trade their own account that follow us, and they refer their friends and family because they don't. It's hard to do. Trading is hard too. You still got to be good at it. So, anyway,
all right, let's have the team's presentations. We'll start off with Connor.
Yeah. So, Don gave a great summary of the market. And, now that we have the market wind behind our back, I wanted to talk about 3 different sectors right now with 3 different stocks that are showing great relative strength and super strong. So kind of like I've talked about it before in a couple podcasts, but taking that 3-pronged approach, right? Number 1 is the market environment, and you've seen the trend gauge. We have the green arrows there. So that's behind our back. And then the second is, what's the big theme of the market right now? And when you comb through thousands of charts, sometimes on a day, you start to get a good feel. And the number 1 sector that I'm seeing is the power generation stocks. And basically, these are very strong because it's a big theme that, there needs to be power for these data centers. And so some of the leading ones in there right now, first one is OKLO. And to me, this is probably one of the strongest ones. It's a volatile stock. This thing's up about 55% in the last month. So, super strong. It's getting huge volume, and they're part of the nuclear energy group. And that's, making another higher high today. Clearly short term, it's a bit extended, but when you see stocks make big moves on big volume, you don't want to take them off the radar because, you'll likely get a consolidation. So that's a good one to put on your watch list. Next one is GEV, which we all own, cross protection and turbotection. And this, GEV is a diversified one. And again, similar story with the power demand and electricity needs. This one's another leader. And this one just reported earnings 2 days ago. They missed on EPS, gapped down lower pre-market, got bought back up, and made a new high the following day. And now it's kind of just down a bit today, but this has been on a big run, so deserves a rest. And then the next one is CEG, another very strong one. This one gapped up on that initial catalyst and then pulled back and then started U-turning higher. So, you can see, I like to say, when institutions want certain names in a sector, they can't hide. And I could give you another five, six different names from this group, but for time's sake, just keeping the list of those three. Another strong, VST is another one, NNE is another one. So there's a handful of those names right now working. Next one is data center stocks. These have came back up quite nicely as well. VRT is the leader here. Took a starter here in Grotection today as well, but this one broke out, coming back to the top of the base. So, first little breather since it's moved up off the lows, and the story for this one is alive and well. With next one, STX. This one's shot back up really strongly lately. It was a huge laggard for the last couple months, back below the 200-day, but you can see this has shot up really strongly the last couple weeks, back above all the moving averages. So would love to see this one start to base a little bit and form a handle or a flag. And then last one is Coherent, one that we've tracked for a while now. We traded it before as well, but this has got a really clean base here, and it's getting back into that relative strength phase. So like the names in the data center space as well. And then semiconductors, they are coming back to life as well. Kind of some new leadership. MRVL's been very strong lately. This one started up on its earnings gap, and now it's trying to close at another new high today. AVGO, this is another one, and also started off that earnings gap, and it's just kind of been consolidating, and it's getting a nice bid today. Watching to see if this one can break out. And then SMTC, this one recently broke out of a nice little flat base, and now it's consolidating. So keep an eye on that one for a secondary flag, but looks really good nevertheless. And if you look at NVIDIA's coming back. It's back above 140. It showed some nice relative strength lately. So if NVIDIA's working, you'd imagine the whole semiconductor as a whole, group as a whole would work as well. And then just some honorary groups as well that look good. In software, you have Twilio and Palantir, two really strong names. Crypto, Coinbase is leading now along with Robinhood. And they've kind of decoupled from MSTR. Towards the tail end of 2024, MSTR, was the beta name to own for Bitcoin. But now with Saylor diluting it quite a bit, it's just kind of lagging here. And then some other ones that, actually are quite liquid. You can look at names like Iris Energy. They also have the data center angle, and they also have the Bitcoin mining play. That's coming up today. It's got a big base, big consolidation. Wolf's another one, TerraWolf. So, there's a lot of good looking stocks right now. And, when there's so many, I always like to narrow it down through what's the strongest group right now and then pick the strongest name in that group. But, I could go on all day talking about a bunch of different stocks, and, some stocks not necessarily in a big theme, but act really well. Bros, we hold that in Grotection. That's Dutch Bros Coffee. And then, Reddit, that's another one that's holding at highs. So no shortage of stocks right now. And that's usually our best gauge. If there's a lot of stocks, then our belief is the market's going to stay strong until they give us a reason to think not.
Good stuff, Connor. Ted, take it away. Talk about crypto.
Yep. To continue off Connor's part of his last segment, apart from AI, which we've been focused on for the last 2 years, I think that this new administration that just took office this week actually was a step shift for the crypto industry. They pretty much overnight, after Trump won and took office, became known as criminals by the government. all the way to the government almost wanting to hold Bitcoin and actually accumulate Bitcoin, which is definitely in the development right now. And we aren't fully sure if they're going to start a Bitcoin strategic reserve. But what we do know now is that Trump did sign some executive orders yesterday. The first one was he set up a crypto working group. And pretty much what that means is he has his crypto and AI czar, David Sachs, heading that with the pro-crypto SEC chair that he nominated, as well as his new Treasury Secretary, Scott Bessent. And pretty much this is the first administration ever to really embrace crypto and actually be pro-crypto. And Trump has said multiple times that he wants the US to be the crypto capital of the world, as well as the AI capital of the world. So those two sectors, definitely many tailwinds with the government behind their back. On the technical side of things, here's the Bitcoin chart. We've talked about Bitcoin a lot and crypto a lot on this podcast. Just quickly reviewing this last base that we came out of. It was an 8-month base breakout, and it was catalyzed by the election win. We broke up from 72,000 all the way to 108,000. And more recently, we've just been pulling back. It was a 50% plus move in an asset like Bitcoin. Is pretty big. So just needed some regular digestion, an exchange of weak hands into strong hands. And we had this undercut reclaim of 90,000. And to us, that signaled that the last of the weak hands were washed out. The strong hands accumulated all of it and really pushed it straight back into highs. We saw a failed breakout because the markets were anticipating Trump to sign an executive order on inauguration. That didn't happen, so we closed weak that day on January 20th. But recently, we've been building this handle extremely constructively. We have this flat top horizontal line at around 108,000. That's really what I'm keying in on here. And we have a double inside day as well. Just an inside day. And right now we're testing the previous high of the day. I think if we do take out that level, we might be in for another leg up. And so that is the Bitcoin chart. Another stock that really has changed character is Coinbase. And I'll go back to my market search for this. Today, Bitcoin is up and MSTR is struggling. But Coin has been keeping up with Bitcoin. And institutions still don't fully understand Coinbase. And with the deregulation coming to the markets and the economy, especially related to crypto, there's just so many tailwinds behind Coinbase. And rumors are that if the US does start a Bitcoin strategic reserve, they'll buy the Bitcoin through Coinbase. And on top of that, Coinbase also is the custody of pretty much every single Bitcoin ETF, including the big BlackRock ETF, which is IBIT. And we own this in both Grotection and Turbotection. And this looks really good. Over this 6108 high right here, that line. And I think the next leg is coming up. At least that's what the chart tells us. And yeah, so this is definitely a sector I'm extremely bullish on, as you probably know. And this continuation-based pattern has just been flawless. It has the perfect shakeout handle, getting tight, and we're looking to break out to new highs.
Was that undercut and reclaim, was that 113 as well? Same as the market that day? Yep.
Yes, it was.
Yep. And I know we talked about that on the video. So, all right, Ted, that's everything?
Oh, yeah.
All right, thanks.
Yep,
Dan,
that's it from me.
Dan, take us on home.
All right, folks, thanks. If you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. It will send you our daily market insight video every day the market's open, and you'll get this podcast delivered straight to your inbox on Saturday morning. However, if you go to YouTube and just search for Revere Asset, just Revere Asset, hit subscribe, this will be in your inbox by about 12:30 or 1 on Friday Central Time, because we send it out as soon as we publish it. So there's two ways to get our stuff, via our email or YouTube at Revere Asset. Most people do both. And there's next to it, there's a contact us button, so you can reach out to me and ask for a complimentary portfolio review. Folks, learn a better way. so that you don't get a pie charts us portfolio, whether it's nefarious or whether it's just incompetence. You got to learn a better way to invest. Use relative strength so you don't get rotten stocks in your portfolio. We'll talk to you next week on Your Money, not Wall Street's money, your money.
It's not how much you make in the market, it's about how much you can keep.